Stoneco is a financial services company primarily focused on the Latin American market, and the stock price is down 90% off its long-term high it reached in 2021. In this video, I'm going to share with you the company's latest results, compare it against its valuation, and talk a little more broadly about the business fundamentals to argue why I think this growth stock at this valuation is ridiculously cheap. So let's take a look at this interesting financial services business.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So like I shared with you in the introduction of the video, the stock price is down hugely off the high, 89.7% off the highs that it reached in 2021, early 2021 here. So let's see what's going on recently with Stoneco, right? So profitability in the financial services segment remained the highlight, with MSMB take rate, which is the micro small business, reaching a record 2.58%. Given the increase in credit portfolio and banking revenues combined with the stable competitive environment in payments. And let me zoom out a little bit. A couple of years ago, I want to say maybe 7 or 8 quarters ago, Stoneco started a shift in the strategy, focusing more so on the MSMB market, the very small business market, because they generate a higher profit margin serving these customers than they do their VIP customers, or what they used to call the key customers. And it's understandable that they would want to shift to this more profitable customer. And I highlighted when they undertook this strategy shift that I like that strategy. And some other financial services companies are also undertaking a similar strategy. Another Latin American financial services company, New Holdings, is doing something similar. In the US, PayPal is doing something similar. And so this going after the more profitable customer has been an ongoing trend ever since interest rates increased. And when interest rates increase, investors place greater focus on profits and cash flow and less focus on growth. Because when interest rates increase, the cost of capital is increasing. And so investors want to see profits sooner rather than later. And so that's why these strategic changes you've noticed happening a lot more since interest rates increased. Before that, many businesses were happy sacrificing profits in the near term, going after growth opportunities that might not pay off for 5 years or more. Ever since interest rates jumped by more than 500 basis points worldwide, companies have become more prudent and more near-term focused, putting the business on more sustainable footing right now. And so in addition to increasing volume, the company's credit portfolio continues to be a highlight, with vintage indicators corroborating their credit models. That's good to hear. What that means in layman's terms is that when the company was making calculations on how many people it thought were going to default on the lending, that's actually what's happening, right? They're in line with what the company calculated. It would be bad if they said, you know what, defaults are higher than what we thought, okay? So they've also delivered on the roadmap of products, launching credit cards and revolving credit facilities. And worldwide, credit performance has been much better than expected. And you can go back to the impacts of the pandemic and how it positively impacted people's financial lives worldwide. Now, health-wise, of course, it was a disaster, but financially, it benefited many people around the world because of the trillions and trillions of dollars of stimulus that governments poured into economies worldwide. And roughly everyone benefited around the world from that stimulus. Even if you were in a country that did not offer stimulus, because of other countries, larger countries like the United States that did offer stimulus, that spending from US consumers lifted worldwide economies. And so that's been a positive impact, and it's sustained even as economies reopened, people's financial balance sheets were improved, and that improvement has sustained. And so performance on credit products has been much better than expected. And on top of that, as an added benefit, even though interest rates increased, we didn't see the hugely negative impact that usually comes along with higher interest rates, which is a decrease in consumer spending. We didn't see that happen either. So it's been much better than expected, and a financial services company like Stoneco that's exposed to the macroeconomic changes significantly benefits from those impacts. They've also been prudent with cutting costs. Their administrative expenses decreased by almost 7% year to date, and they're on track to beat their 2024 guidance. Lower selling expenses led the way to a 150 basis points increase in their adjusted pre-tax margin, reaching 21.8%. And I like to see companies with prudent financial management even when the business is growing. I don't like when companies just wait until there's a disaster and then they start thinking about cutting costs, and then it's become much more bloated than it needs to be, and then it becomes much more difficult to cut costs. I like when they undertake this strategy as part of their growth strategy, maintain focus on cost, keep costs under control, and don't let them get elevated and then lead to a disaster sometime down the road. That's why when you're focused on serving your best customers, in other words, serving the customers that you're in the best position to serve, customer selection, it gives you time to focus on internal strategies like cutting costs. But when you're just focused off their growth, you don't have the time and the resources to focus on keeping your costs under control, and your business gets all out of whack. And that's why I don't like those strategies when I see businesses implement them. I like the strategies that I see Stoneco implementing: more profitable focus on profitable growth, and at the same time keeping costs under control. So one of the things investors have not liked about Stoneco is the slowing growth rate. Revenue in the latest quarter increased by just 6.9% when the market overall grew much faster and other financial services companies grew at a much faster rate. But in terms of profitability, adjusted earnings before taxes jumped by 35% at Stoneco. And then looking ahead, they're on track to deliver their 2024 guidance, and they've already delivered on their 2024 guidance in one of their categories, which is the credit portfolio. Active clients in their growth focus segment, the micro and small business client, grew 21% year over year. The banking active client base reached 2.8 million, 47% higher year over year and 5.1% higher quarter over quarter. And not only that, but the banking average revenue per customer increased by 12.1% and 11.3% quarter over quarter. So not only are they adding more customers, but they're also increasing engagement from existing customers. So despite some of those positive impacts the business is implementing, the slower growth and the higher risks in financial services has brought the company's valuation down to a ridiculously cheap level. It's now trading at a forward price to earnings of just 6.916. This is what a zero growth rate stock would trade at. And so I think at this valuation, Stoneco is an attractive investment for long-term investors. And I reiterated this buy recommendation today, November 15, for Stoneco. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.